when you look at a legacy medical device giant, like a $36 billion behemoth, you sort of expect predictable, sluggish movement.
Right, yeah. You expect a defensive, dividend-paying stock that, maybe barely outpaces inflation if you're lucky.
Exactly. But welcome to this special talk tickers edition of the Deep Dive, everyone. Our mission today for you listening is to really cut through the Wall Street jargon and deliver a rapid-fire, data-forward breakdown of Medtronic's Q4 2026 earnings call.
Ticker symbol MDT.
Ticker symbol MDT, yes.
Yeah.
Custom tailored for the retail investor because, well, if you open up their transcript, they just posted their strongest top-line performance in 10 years.
10 years, which is wild for a company of this sheer scale.
It is wild. And so we're tearing into this today because, frankly, if you are holding or even just considering MDT for your portfolio, this is a crucial briefing.
Yeah.
We need to figure out how they pulled off this kind of acceleration.
Yeah, and more importantly, whether this is, a genuine structural turnaround or if it's just pandemic recovery noise that's sort of masking a deeper issue.
Right, exactly. Is it real growth or just clever accounting?
It's the critical question, really, for anyone looking at the healthcare sector right now. When you see a company of this size suddenly shifting gears, you have to look past the top-line gloss.
Yeah, you really do.
We need to dissect the actual operating leverage, the clinical trial data driving their adoption, and honestly, whether their margins can withstand this crazy inflationary environment we're in.
Okay, let's unpack this. Because it's like turning around a $36 billion medical device company is like trying to steer a massive cargo ship, right?
Absolutely.
But somehow, Medtronic is showing the agility of a speedboat with these growth numbers. So let's hit the headline numbers first, just to set the baseline.
Let's do it.
So Q4 revenue came in at $9.8 billion.
Yep.
That is up 9.9% on a reported basis and 6.6% organically.
Right.
And for the full fiscal year 2026, they delivered $36.4 billion in total revenue, up 8.4% reported and 5.8% organically.
Which handily beat the street's estimates, by the way.
It did. And I'm looking at those organic numbers, like 6.6% in a single quarter for a company operating in over 150 countries. How are they generating that kind of volume without sacrificing their pricing power?
Well, the pricing power is actually kind of the hidden engine here. I mean, when you look at the adjusted earnings per share EPS, they hit $1.55 for the fourth quarter.
Okay.
And $5.53 for the full year. So they beat expectations on both the top and bottom lines. Mm-hmm. But what's really telling, is the free cash flow.
Oh, the cash flow is massive.
It really is. They generated $5.4 billion in free cash flow for the year. That's the strongest liquidity profile they've demonstrated since I think 2022.
Right.
And they ended the year sitting on $9.2 billion in cash and investments.
$9.2 billion in the war chest. I mean, wow. We definitely need to dig into their M&A strategy later because they've been on an absolute shopping spree with that cash.
Oh, we will get into that for sure.
But I want to zero in on the margins first. Because, inflation hasn't just magically disappeared.
No, definitely not.
The raw materials cost more. Global freight is an absolute nightmare right now. How did their gross margin actually perform against all those headwinds?
Well, their adjusted gross margin actually ticked up to 65.4%.
Wait, really?
Yeah. That is a 30 basis point jump year over year and a 50 basis point jump sequentially just in the third quarter.
Let me stop you right there because expanding gross margins in this kind of macroeconomic environment is, it's incredibly difficult, especially with the tariff situation. Like I saw in the transcript, they took a $74 million hit just from tariffs this quarter alone.
They did, yeah. That tariff impact alone dragged their margin down by 80 basis points.
Yeah.
And they also faced negative mix impacts.
Mix impacts. Just translate that for the listener real quick.
Sure. So in the medical device world, mix refers to the ratio of high margin consumables versus lower margin capital equipment.
Ah, okay. The razor and blades model.
Exactly. And they sold a much higher proportion of capital equipment this quarter. The actual massive machines and robotic systems that hospitals install.
Which have lower margins than the disposables.
Right, compared to the high-margin catheters and disposables that they use every day. Mm-hmm. So they essentially have the wind in their face from tariffs, plus a product mix that naturally depresses margins.
So they're swimming upstream against supply chain costs, and the product mix is working against them. Walk me through the mechanics of how they actually managed to expand that margin to 65.4% despite all of that. Like, what levers are they pulling on the actual factory floor?
It really comes down to two highly disciplined operational levers. First, they successfully pushed through price increases, which gave them a 30 basis point benefit. And hospitals are accepting these price hikes because the technology is becoming completely essential, which, we'll discuss when we get into the story behind the numbers and their new product launches.
Right.
But the second, and honestly more crucial lever, is their cost of goods sold efficiency. Their global operations team completely overhauled their manufacturing yields and material sourcing.
Yield improvements, meaning what? They're literally just producing less waste on the manufacturing line?
Precisely that. They're getting more usable product out of the exact same raw materials. And those efficiency programs contributed 60 basis points of benefit.
Wow.
Entirely net of inflation. So when you strip away the macroeconomic noise, they're just structurally more efficient at building their devices than they were 12 months ago.
See, that's the kind of operational rigor that separates a lucky quarter from a sustainable turnaround. You love to see that as an investor, but cost cutting only gets you so far, right?
Right. Eventually you have to sell things.
Exactly. The top line growth has to come from actual product demand. And I was looking at their cardiovascular segment, and there's one specific division that completely threw me off. The Cardiac Ablation Solutions business. CAS.
Oh, yeah. CAS is a monster right now.
What exactly is going on there to justify what looks like software company level growth? 124% growth in the US alone for a medical device.
Yeah, it's staggering. The CAS division grew 78% globally, and like you said, 124% in the US. They gained an additional 8 points of market share just in this quarter alone.
That's huge.
And the business is now annualizing at over $2 billion.
$2 billion. Okay, so why? Why is it exploding like this?
To understand that, you have to understand the clinical problem they are solving, which is atrial fibrillation, or AFib.
Right, the irregular heartbeat issue.
Exactly. So the heart has an electrical system that controls its rhythm, right? In AFib, faulty electrical signals cause the upper chambers of the heart to quiver instead of beating effectively.
Which is super dangerous.
Very. It can lead to blood clots, strokes, heart failure. And for decades, the standard of care for severe AFib has been cardiac ablation.
Okay, so just for the listener, how does traditional ablation actually work in practice? Like mechanically?
So a surgeon threads a catheter through a vein up into the heart and intentionally creates scar tissue.
To basically block those faulty electrical signals.
Exactly. Yeah. Historically, they did this using either radiofrequency ablation, which uses extreme heat to literally burn the tissue, or cryoablation, which uses extreme cold to freeze it.
But wait, the heart is surrounded by some pretty critical real estate, right? You've got the esophagus right there. You have the phrenic nerve that controls your diaphragm. If a surgeon is going in there with extreme heat or extreme cold, that sounds incredibly risky.
That is exactly the clinical bottleneck.
Yeah.
Traditional thermal ablation causes collateral damage. So surgeons have to work incredibly slowly, incredibly carefully to avoid permanently damaging the esophagus or, paralyzing the patient's diaphragm.
Right, which nobody wants.
No. And it makes the procedure long, it makes it complex, and it severely limits how many patients a single hospital can treat in a day. Okay,
so this brings us to what management was highlighting on the call, which is pulse field ablation, or PFA.
Yes, PFA is the game changer.
They specifically called out their Sphere 9 catheter, right, which saw, 145% global growth?
Yeah, 145%.
So from what I understand about PFA, it doesn't use temperature at all. It's almost like an EMP, like an electromagnetic pulse. Instead of using a flamethrower to burn out the bad tissue and accidentally scorching everything around it, PFA drops a highly targeted electrical field that specifically knocks out the faulty wiring in the heart muscle, but completely ignores the surrounding nerves and tissue. Is that right?
That is actually a highly accurate way to visualize it. The medical term for it is electroporation.
Electroporation, okay.
Yeah, so PFA delivers these really short, high-voltage electrical fields that create microscopic pores in the membranes of cardiomyocytes.
Which are the heart muscle cells.
Right. And because different types of tissue have completely different thresholds for electrical disruption, the voltage is calibrated to destroy only the targeted heart tissue, leaving the esophagus and the phrenic nerve completely unharmed.
That is wild. The science behind that is just incredible. Also, it totally removes the bottleneck. If the surgeon isn't worried about, accidentally burning a hole in the patient's esophagus, they can move much, much faster.
Yes. And that is the financial catalyst. It dramatically improves operating room throughput. A procedure that used to take hours can now be done in a fraction of the time.
Meaning more procedures per day.
Exactly. Hospitals can treat more patients per day, which drastically improves the profitability of their electrophysiology labs. And this is exactly why Medtronic increased their installed base of these PFA systems by 40% sequentially in the US just this quarter.
Right. Let's talk about that installed base metric, because that seems fundamental to their entire revenue model going forward. When a hospital buys the actual machine that generates the pulse, the capital equipment, that's a one-time sale, right?
Correct. And as we discussed earlier, it's typically a lower margin sale.
Right.
But securing that real estate in the operating room is everything, because once that machine is installed, the hospital has to buy Medtronic's proprietary Sphere 9 catheters for every single procedure they do.
Yeah. It is the ultimate razor and blades model.
It really is. By expanding the installed base by 40% in just 3 months, they are locking in years, maybe decades, of highly profitable, recurring, consumable revenue.
And it's not even just the physical catheter, is it? They're selling the entire digital ecosystem around it. Like, the transcript mentioned the rollout of Prism 2. What exactly does this mapping software do? Why does a surgeon need hybrid impedance and magnetic mapping?
Well, think about it. When you are inside a beating human heart, you need a highly accurate 3D GPS system to know exactly where your catheter is at all times.
Okay, that makes sense.
Prism 2 combines 2 types of spatial tracking. Magnetic tracking uses a magnetic field under the patient to pinpoint the exact location of the sensor inside the catheter.
Oh, interesting.
And then impedance tracking measures the electrical resistance between the catheter and patches placed on the patient's skin.
So it's basically triangulating the position using both magnets and electrical currents to give this high-resolution, real-time map of the inside of the heart.
Exactly. It allows the surgeon to visualize the anatomy, track the catheter with sub-millimeter accuracy, and confirm that the ablation lesions are continuous, so those faulty signals can't break through again.
Wow.
And because this software is completely proprietary to Medtronic, it creates an incredibly sticky ecosystem. I mean, they just launched Sphere 9 in Japan, and they have the Sphere 360 catheter, which is a single-shot, rotation-free catheter launching in Europe and currently enrolling in U.S. trials.
So they are just systematically surrounding the entire electrophysiology market.
Exactly.
Taking a $14 billion market that's growing at 20% and just eating market share through sheer technological superiority. It's brilliant.
It really is.
But, I want to pivot from electrophysiology for a second to something else that caught my eye on the call, because it feels like they are trying to create an entirely new standard of care here. They spent a lot of time talking about hypertension, specifically a treatment called Simplicity.
Oh, yeah. This is a fascinating area because it really bridges device technology with what is typically viewed as a strictly pharmaceutical market.
Right. People just take pills for high blood pressure.
Exactly. But there are roughly 18 million people in the U.S. alone living with uncontrolled hypertension.
18 million.
Yeah. These are patients who remain at high risk for major cardiovascular events despite taking multiple blood pressure medications. The drugs just aren't enough for them.
So if drugs aren't working, how does a medical device fix high blood pressure? I've read that Simplicity uses a process called renal denervation. Walk me through the mechanics of that, because that sounds intense.
It's actually really elegant. It comes down to the sympathetic nervous system. The kidneys and the brain are in this constant communication loop via a network of nerves wrapped around the renal arteries.
Okay, the renal artery is going to the kidneys.
Right? In many patients with severe hypertension, this communication loop becomes hyperactive. The kidneys signal the brain to increase blood pressure, and they also retain excess salt and water, which just further drives up the pressure.
So it's like a feedback loop that gets stuck in the on position.
Exactly.
And Simplicity acts like, what, a circuit breaker?
That's exactly how it functions. The surgeon inserts a specialized catheter into the renal artery, and the device delivers focused radio frequency energy to gently ablate or basically calm down those overactive nerves surrounding the artery.
Okay.
And by interrupting that hyperactive signaling, the kidneys stop retaining all that excess salt and water, and the overall sympathetic drive to the heart and blood vessels decreases.
But does it actually work in practice? Because, correct me if I'm wrong, but I know the history of renal denervation has been pretty rocky in the medical community. Weren't there some highly publicized clinical trial failures years ago where the sham-controlled trials didn't really show enough benefit?
You're absolutely right to bring that up. You're referring to the older generation of trials, which, frankly, struggled with consistent ablation techniques. The technology just wasn't there yet.
Okay, so what changed?
Medtronic persisted and completely redesigned their approach. And the recent clinical data they just presented at the CRT conference showed sustained systolic blood pressure reductions of 13.3 and 18.1 points.
Wow. And a reduction like that is massive in terms of patient outcomes, right? I think management noted that just a 10-point reduction in blood pressure results in a greater than 20% reduction in major cardiovascular events like heart attacks, strokes, heart failure.
Yes.
So that's not just a marginal improvement for the patient. That is actively keeping people out of the emergency room.
It fundamentally alters the trajectory of the disease. But, from an investment perspective, the true catalyst here happened just before this quarter. They received a National Coverage Determination, or NCD, from Medicare.
Okay, let's clarify that for the listeners, because NCD is a term that gets thrown around on Wall Street a lot in the MedTech space. Why is an NC3 the holy grail for a medical device company?
Because in the United States, getting a device approved by the FDA simply means the government agrees it is safe and effective.
Right.
It does not mean anyone will actually pay for it.
Ah, right. The insurance hurdle.
Exactly. A national coverage determination means the Centers for Medicare and Medicaid Services, CMS, has reviewed all the clinical data and officially agreed to reimburse hospitals and doctors for performing this procedure across the entire country.
And once Medicare agrees to pay for it, the private insurers usually just fall right in line, right?
They almost always do. It flips the switch from this being a niche sort of experimental procedure to being a commercially viable standard of care.
Right.
And since receiving that NCD, Medtronic's weekly procedure volumes for Simplicity have literally doubled. The business is now annualizing at $100 million in revenue.
That is incredible. They have essentially commercialized a mechanical solution for a biological problem that pharmaceuticals just couldn't solve.
Exactly.
But let me stop you right there, because Wall Street was practically sounding the alarm bells on their structural heart business just a few months ago. Like, this whole narrative of Medtronic firing on all cylinders sounds great today, but what about TAVR?
Ah, yes. Transcatheter aortic valve replacement.
Yeah. Everyone was panicking earlier this year that their eVolit product was rapidly losing market share. Did that drag down this quarter's numbers?
You are absolutely right to challenge the narratives here, because the structural heart segment was, without a doubt, the glaring weak spot in this report. It was completely flat this quarter, zero growth.
Zero growth. So the panic from the analysts was justified. What exactly happened there?
Well, to understand the slowdown, we have to look at the clinical data again. TAVR is used to treat severe aortic stenosis, which is a narrowing of the heart's aortic valve. Instead of cracking the chest open for traditional open heart surgery, they deliver a new valve via a catheter. And Medtronic's platform for this is called eVoliti.
Okay.
So recently, some highly anticipated clinical trial data was released regarding the use of these valves in what they call low-risk patients.
Meaning what? Younger, healthier patients.
Exactly. Younger, healthier patients who could technically survive an open heart surgery, but obviously prefer the much less invasive TAVR option.
Naturally. And let me guess, the data didn't exactly favor Medtronic.
It presented a very mixed picture, particularly concerning certain metrics of valve durability and hemodynamics in specific patient anatomies.
Ouch.
Competitors immediately capitalized on this, and it caused a lot of hesitation among U.S. surgeons, specifically when choosing valves for larger anatomies.
So doctors saw this low-risk data and started pivoting to competitors. Okay, that explains the flat growth. But did management give any indication that they've stopped the bleeding here? Because zero growth is not going to cut it.
They did address it head on. The CEO explicitly stated that over the last 8 to 10 weeks of the quarter, their weekly U.S. procedure volumes for eVolute had actually stabilized.
Okay, so it's not a free fall anymore.
No, the sharp decline they saw immediately following that data release has definitely leveled off. And furthermore, they pointed out that this competitive pressure is almost entirely isolated to the U.S. market. Internationally, their structural heart performance remains really robust.
And I imagine they aren't just sitting still letting competitors take the low-risk category, right? They've got that $9.2 billion war chest.
Absolutely not. They are pouring R&D into next-generation valves, and they're expanding heavily into mitral and tricuspid valve replacements. They also highlighted their external investments, specifically in a company called Antares, to develop entirely new structural heart technologies.
So while TAVR was undeniably a speed bump in the U.S., the stabilization of volumes over those last 8 weeks suggests it won't permanently derail the broader cardiovascular growth engine. Which actually brings me to another major strategic move they executed this quarter, the diabetes segment.
Yes, the spinoff.
Right. So the segment grew 15% reported, or 8.1% organically. But the big headline is that they just finalized the initial public offering to spin out their MiniMed Diabetes unit as a standalone publicly traded company.
Right.
And I have to ask, if a business unit is growing organically at over 8%, and they are about to launch their new MiniMed Flex product this summer, why get rid of it? Why spin it off?
It is entirely about capital allocation and margin profiles.
Okay, break that down for me.
So to understand the spinoff, you have to look at the competitive landscape of the diabetes market right now. The transition from traditional blood glucose testing to continuous glucose monitors, CGMs, and automated insulin pumps has been fiercely competitive.
This is the whole race for the artificial pancreas, right? A closed-loop system where the CGM reads the blood sugar, and the pump automatically delivers the exact right amount of insulin without the patient doing anything manually.
Precisely. And while Medtronic's MiniMed platform has historically been a pioneer in this space, keeping up with pure-play diabetes competitors requires a massive, continuous burn of research and development capital.
So even though the revenue is growing at 8%, the actual cost to generate that revenue is dragging down the rest of the company.
Exactly. Management fully acknowledged that the diabetes business is structurally less profitable than Medtronic's broader portfolio. The operating margins in diabetes simply do not match the massive margins they are seeing in areas like cardiac ablation or robotics.
You know, it reminds me of how legacy tech companies handle their divisions.
How so?
Like, you have a hardware division that makes steady money but has terrible margins, and then a software division that is hyper profitable. If you keep them together under one ticker, Wall Street averages out the valuation and basically punishes the stock.
Yes.
But if you spin off the lower margin hardware business, suddenly the core company's profit margins skyrocket, and the spinoff can raise its own capital independently without fighting for internal budget.
That is the exact financial mechanism at play here. By separating MiniMed, Medtronic stops diluting its overall corporate margins. It allows MiniMed to operate with its own dedicated management team, its own access to capital markets.
Right.
But more importantly for Medtronic shareholders, it frees up billions in internal cash flow to redirect directly into their highest margin, highest growth ecosystems.
Ecosystems like robotics and artificial intelligence.
Exactly.
Which is a perfect segue, actually. Let's dive into their neuroscience and surgical portfolios, because this is where the cash from that spinoff is going to end up. They reported that worldwide procedure volume growth for their Hugo robotic-assisted surgery system is 2 to 3 times the market rate. 2 to 3 times.
Yeah, and you have to remember, the robotic surgery market has historically been dominated by a single player, Intuitive Surgical, with their Da Vinci system.
Right, Da Vinci's everywhere.
Medtronic's entry with the Hugo system was designed to break that monopoly by offering a more modular, flexible system. And the volume growth indicates that hospitals are highly receptive to having a competitive alternative.
I bet they are. Nobody likes a monopoly when they're buying million-dollar machines.
Exactly. They are expanding the rollout in urology in the U.S. right now, and they just submitted to the FDA for general surgery and gynecologic indications.
But you know what fascinates me isn't just the robotic arms physically doing the cutting, it's the data pipeline behind it. They highlighted their touch surgery digital ecosystem, which now has over 1,400 installations. That is up 30% sequentially. What does touch surgery actually do?
So Touch Surgery is an AI-powered surgical video and analytics platform. It connects directly to the operating room cameras and uses computer vision to automatically record, segment, and analyze surgical procedures.
So it's literally like game film for surgeons. They can go back and see exactly how long a specific part of the procedure took, analyze their technique, and compare it to, like, aggregated data from other hospitals.
It is exactly like game film, but it also serves a massive strategic purpose for Medtronic as a company. By integrating touch surgery into hospitals, they are embedding their software into the daily workflow of the surgical department. They are turning isolated, one-off surgical procedures into a continuous, data-driven digital ecosystem.
And we see this identical strategy playing out in their neuroscience portfolio, too.
Oh, absolutely.
Their cranial and spinal technologies business grew 3%, and management attributed that entirely to the adoption of their navigation systems following the launch of the Stealth Access platform. They explicitly called Stealth Access a force multiplier. How does that actually work in spine surgery?
Well, spine surgery requires absolute mechanical precision. I mean, a single millimeter of error when placing a pedicle screw can result in severe nerve damage or paralysis.
Right, terrifying.
Stealth Access is an integrated platform that pulls together preoperative planning software, robotic guidance, and real-time navigation.
So a surgeon isn't just looking at a static X-ray on a light board anymore. They map the patient's spine in 3D, plan the exact trajectory of the screws on the software, and then the robotic arm physically guides their instruments along that exact pre-calculated path.
Precisely. And this is exactly why management calls it a force multiplier. Because when a hospital purchases the Stealth Access platform, it naturally promotes the adoption of Medtronic's proprietary spinal implants and robotics.
Because they all communicate seamlessly within the same software ecosystem.
Exactly.
Wow, the switching costs become astronomically high. I mean, if you are a hospital administrator and your entire surgical team is trained on Medtronic's 3D planning software and your operating rooms are wired with their robotics and navigation screens, you aren't going to suddenly switch to a competitor's screws just to save a few dollars.
No, absolutely not.
The disruption to the surgeon's workflow would be catastrophic.
That is the core of their entire enterprise strategy right now. They are building proprietary, highly sticky technological ecosystems, and they are accelerating this across every single franchise they own.
Right.
Like in their pelvic health segment, they highlighted the AltaViva system, which is a neuromodulation device used to treat urge urinary incontinence. Active implants for AltaViva were up 3 times sequentially.
I read the specs on AltaViva. It's crazy. Same-day activation of 15-year battery life, and it's completely MRI compatible. They've already trained nearly 1,000 physicians on it.
Yeah. Neuromodulation is essentially a pacemaker for the bladder. It sends these mild electrical pulses to the sacral nerves to restore normal communication between the brain and the bladder. And by improving the battery life to 15 years and ensuring patients can still get MRIs, which was a huge problem before they've removed the major friction points that historically limited patient adoption.
And they are aggressively using that $9.2 billion cash pile to buy up the missing pieces of all these ecosystems. I saw they announced the planned acquisition of Scientia to expand their neurovascular platform.
Yes.
Now, Scientia makes specialized guide wires. Why would a massive tech giant care about buying a company that just makes wires?
Because in neurovascular procedures, like, say, treating a brain aneurysm or removing a blood clot during a stroke, getting to the actual site of the blockage is the hardest part.
Right. The brain is complicated.
The blood vessels in the brain are incredibly tortuous. They are fragile. Scientia has developed highly differentiated guide wire technology that provides superior maneuverability through those vessels. And as management bluntly stated on the call, owning this technology ensures that, quote, every neurovascular procedure starts with Medtronic.
Every procedure starts with us. That is such an aggressive posture. They are literally controlling the point of entry into the human body.
They are.
And we saw this with the CathWorks transaction too, right? Where they bought into AI-driven coronary imaging and the SPR Therapeutics deal for chronic pain management. They're just planting seeds across the entire healthcare landscape.
It's a very deliberate land grab.
Okay, so we've mapped out the underlying mechanisms of this quarter. We know how they expanded margins despite tariffs. We understand the clinical superiority driving the massive growth in pulse field ablation and simplicity.
Yeah.
We know the TVR panic has stabilized, and we see the strategic brilliance behind spinning off the margin-dilutive diabetes business to fund these high-growth robotic and AI ecosystems.
Right.
But Wall Street doesn't trade on yesterday's performance. Investors price the stock based on what management promises for tomorrow. So let's look at management guidance. How are they actually pricing that future growth?
Well, the guidance for fiscal year 2027 is where the accounting mechanics become really critical for investors to understand.
Okay.
Management is guiding for full year FY27 organic revenue growth of 6.5 to 7.25%.
Which is an acceleration from the 5.8% they literally just posted for FY26.
It is. And on the bottom line, they are guiding for full year adjusted EPS of $5.90 to $6.00.
Okay.
However, the metric that caught everyone's attention and frankly caused some double takes is their projection for the first quarter. They are projecting Q1 organic revenue growth of 11.5 to 12%.
Here's where it gets really interesting. Okay, I have to stop you there. 11.5 to 12% organic growth for a $36 billion company in a single quarter.
Yes.
Are they expecting like a sudden massive surge in people getting cardiac ablations and robotic surgeries the second the summer calendar hits? Because that kind of jump seems mechanically impossible without a massive market catalyst.
It would be impossible under normal circumstances, absolutely. But this is where we have to look past the headline percentage and understand a very specific corporate calendar quirk.
A calendar quirk.
Yes. That 11.5 to 12% Q1 growth includes a 500 to 600 basis point tailwind purely because of an anomaly in their calendar.
Wait, what exactly does that mean? How does a calendar create 600 basis points of growth? Are they just inventing days?
Well, sort of. Corporate fiscal calendars do not always align perfectly with the standard 365-day Gregorian calendar. Many companies operate on a 52-week fiscal year, broken down into exactly 13-week quarters to make year-over-year comparisons consistent.
Okay, that makes sense. Because if a quarter ended on a Wednesday one year and a Friday the next year, it would completely throw off the billing cycles.
Exactly. But because 52 weeks is only 364 days, the fiscal calendar slowly drifts away from the actual calendar over time. It loses a day every year.
Oh.
Right. To realign them, roughly every 5 to 6 years, a company has to add a 53rd week to their fiscal year. And for Medtronic, that extra selling week falls directly in the first quarter of fiscal 2027.
Wait, really? So they literally just have an extra week of sales to report compared to the exact same quarter last year?
Yes. That single extra week accounts for 5 to 6 percentage points of that Q1 growth rate. When you strip out that calendar noise, the underlying organic growth for Q1 is actually projected at 5.5 to 6%.
Wow. Okay, but to be fair, 5.5 to 6% is still an incredibly healthy number.
It is.
It proves that the momentum from Q4 is carrying forward steadily. It's not a magical summer surge in surgeries, it's just a mathematical quirk of accounting. But there is another layer of accounting here that retail investors need to fully grasp, and it goes back to the diabetes spinoff.
Right. The EPS guidance of 5.90 to 6.00 requires significant context here. Because the separation of the MiniMed business has not been fully finalized yet, Medtronic is still technically the majority shareholder. Strict accounting rules dictate that they must include the full year of the diabetes business in their forward estimates.
And as we established earlier, the diabetes business operates at a structurally lower margin than the rest of the company. It's a drag.
Correct. The CFO, Thierry Payton, was very explicit about this during the Q&A session. He stated that they have baked the monthly margin dilution from the diabetes business into that 5.90, 6.000 EPS guidance for the entire 12-month fiscal year.
Wow.
They are also assuming zero benefit from any reduced share count that would typically follow a separation like this.
So they're essentially sandbagging their own guidance. They are promising Wall Street roughly $6 a share while deliberately carrying a financial weight they fully intend to drop halfway through the race.
That is the most logical interpretation, yes. The CFO plainly stated, quote, "Should we separate prior to the year end, as per our intent, we could see potential upside from our current guidance." If that spinoff completes in Q2 or Q3, Medtronic's overall corporate margin will automatically step up. The drag on their bottom line disappears overnight. And that EPS guidance could be subject to a very significant upward revision.
That presents a very compelling risk-reward setup for investors. But, to be totally objective here, what are the actual risks baked into that guidance? They must be projecting some ongoing macroeconomic friction.
Oh, they definitely are. They're carrying several heavy assumptions. First, they're factoring in a 2% dilution to their EPS from their recent flurry of mergers and acquisitions.
Because when you buy companies like Scientia or CathWorks, you are paying a premium for the technology and the R&D, but they aren't necessarily generating massive profits on day one. It takes time to integrate them, which temporarily dilutes your overall earnings.
Precisely. In fact, that 2% dilution is actually a point higher than they previously expected, simply because they closed those deals much faster than anticipated.
Which is a good problem to have, honestly.
Right. Second, they are absorbing a full tariff impact projected at $250 million for the year.
$250 million wipes straight off the gross margin line. That hurts.
Yes, it does. And finally, they embedded roughly a 1% headwind from increased global freight and transportation costs. This is largely driven by the ongoing geopolitical conflicts in the Middle East, forcing shipping companies to take much longer, more expensive routes.
Which honestly makes their projection of 5.9 to 6.00 EPS even more structurally impressive. Think about it. They are basically telling the street, we are going to eat $250 million in tariffs. We are absorbing higher global freight costs from geopolitical instability. We are carrying the dilutive weight of the diabetes business for the time being. We are swallowing the upfront costs of our M&A spree, and we are still going to expand our earnings per share.
It is a profound demonstration of operating leverage. As their top-line revenue growth accelerates, driven by PFA, simplicity, and robotics, they get vastly better absorption of their fixed overhead costs. The CFO actually expects their total operating margin to be up 60 basis points for the year.
Right.
This is driven by that manufacturing leverage we discussed earlier and the fact that they won't have to make certain one-time milestone payments they incurred this past year.
Okay, we have completely dissected this quarter. We've mapped out the efficiency programs protecting their margins. We've gone deep into the physiology and the market dominance of pulse field ablation and renal denervation. We understand why the TVR panic was overblown. We see why the diabetes spinoff unlocks capital. And we know how the 53-week fiscal calendar masks the true underlying momentum of their guidance.
We've covered a lot of ground.
We have. Now, we need to synthesize all of this data into a clear, actionable thesis. So, what does this all mean?
The objective here is to determine what this actually means for the retail investor allocating capital in the healthcare space today.
Let me synthesize my read on this, and then I really want your perspective.
Okay, go for it.
Based on the sheer depth of this transcript, the execution on the factory floor, and the clinical superiority of their new pipeline this earnings call is a fundamentally bullish signal. The narrative around Medtronic has permanently shifted. You can no longer look at this company as a slow, defensive healthcare stock that you buy for a safe yield and then just ignore for 10 years. They are aggressively and successfully transitioning into a high-growth medical technology compounding machine.
The structural data supports that thesis entirely. I mean, if you step back and look at the broader macroeconomic picture, the resilience of their end markets is unparalleled.
Right.
The CEO, Jeff Martha, framed it perfectly at the end of the call. The broader economy is wildly unpredictable right now. But MedTech is structurally insulated because the fundamental demand drivers are biological, not economic.
Oh, that's a great point.
The global population is aging rapidly. The incidence of chronic disease from hypertension to atrial fibrillation is rising exponentially.
Right. Because whether interest rates are at 2% or 7%, whether the GDP is expanding or contracting, a patient with severe aortic stenosis still needs a valve replacement. A patient with uncontrolled hypertension still needs an intervention. The demand for these procedures is absolutely inelastic.
Exactly. And Medtronic's strategy is to ensure that when those unavoidable procedures happen, the surgeon is operating entirely within a Medtronic digital ecosystem. They are sitting on $9.2 billion in cash, and they are deploying it with lethal precision. They aren't just protecting their legacy franchises. They are actively taking market share in the most complex, highest growth vectors of modern medicine.
They are replacing traditional thermal ablation with electroporation. They are replacing manual surgical tools with Hugo robotics and touch surgery AI. They are replacing traditional guide wires with highly differentiated neurovascular tech. They made 16 different venture investments totaling $250 million just this year alone.
It's massive.
They're essentially operating as their own internal venture capital firm, funding hyper-growth startups from the cash flow of their legacy businesses, and then ruthlessly pruning the branches like diabetes that no longer fit the margin profile.
The verdict for the listener is clear. If you currently hold a position in Medtronic, the underlying investment thesis is not only intact, it is demonstrably strengthening.
Absolutely.
Management is executing on their operational efficiency programs, and the product pipeline is heavily stacked to capture market share over the next 3 to 5 years.
And if you are sitting on the sidelines considering initiating a position, you have to look beyond the headline calendar quirks. Look at the 40% sequential growth in the PFA installed base. Look at the NCD approval unlocking a $100 million run rate for simplicity. Look at the stealth access platform locking hospitals into their spinal hardware.
Right.
The execution is disciplined, and the upside potential from the pending diabetes spinoff provides a clear near-term catalyst for margin expansion.
It is a textbook case study of a legacy enterprise utilizing its massive global scale, not as an excuse for bureaucratic sluggishness, but as a lever to actively accelerate clinical innovation.
Which actually brings me to a final thought I want to leave you, the listener, with today as you evaluate your own portfolio allocations. Right now, retail investors are completely captivated by artificial intelligence and robotics.
Oh, totally. It's all anyone talks about.
Right. Trillions of dollars are flowing into the tech sector, chasing semiconductor manufacturers, cloud computing providers, software developers. But the healthcare sector is routinely overlooked in these conversations because it's viewed through this traditional defensive lens.
The market categorizes them strictly as medical device manufacturers subject to hospital budgets and regulatory red tape.
Exactly. But if you look at the actual underlying mechanisms of what we just discussed today, if Medtronic's Hugo robotic surgical systems are growing at 3 times the market rate, if their touch surgery platform is using computer vision to aggregate and analyze millions of data points from operating rooms worldwide,
Right.
if their Prism 2 software is using hybrid magnetic and electrical impedance to map the human heart in real time, if they are deploying electromagnetic pulses to selectively alter cellular membranes, shouldn't we start evaluating modern medical device companies not merely as defensive healthcare plays, but as pure play technology stocks?
It's a really provocative question.
If data, robotics, and AI are the future of the global economy, the companies applying those exact technologies directly to the human body might just be the most undervalued tech stocks on the market today.
It completely challenges the conventional boundaries of sector allocation. And identifying those blurred lines between healthcare and technology is precisely where intelligent investors find long-term value.
Keep digging into the clinical data, everyone. Watch the margins on those spinoffs, and always, always look past the headline numbers. Thank you for joining us, and we'll catch you on the next Talk Tickers Deep Dive.